All right, let's move on now. Where are we? 2238 on the VIX. Fantastic. And I'm just going to go to it's not fantastic, but for our discussion coming up, it's going to be fantastic. All right. So yeah, this was the August when we started seeing the sell warnings in the bearish sell warnings at the end of July. That's when I bought the VIX calls. It was down here when they were, no, it was down here. I'm sorry. It's 19th, 18th of July when we saw it at about 1250. It was on a Friday series. I bought them that Friday morning. I bought 8 calls on the VIX. So it must have been over here. Yeah, it must have been when it was over here. I'm sorry. On the 11th, that sounds right. 11th of July, 12th of July. That's when I bought VIX calls. And then when I got 100% profit on them, I sold half. And then at this point, I got a 300% profit. I sold the other half. So I only had 2 remaining. And boop, this happened. And I sold here. So at this point, one point during the day, I saw it when it was at about 39 or so on August 5th. It was a 700% profit. I didn't get a 700% profit. I took 100 on half. It was about a 101 on half, about a 300. And then it ended up being a 280 because I was getting close to my expiration date. It was mid-August, I think, the expiration date I had for those VIX calls. And in any case, I did kind of miss this one here because 15 wasn't low enough from where I usually buy. And now we're seeing the VIX climbing back up again. To ranges what? To ranges where it hasn't been for that long. I mean, we had that recent jump in August. This is just a 3-month chart. Remember, we were just hovering over here around 12 and 11, started seeing those sell warnings, and that's when I jumped in. But this relates to Ram's question. And I wanted to just use this as an illustration. But Ram says, given the increased volatility, how do we manage deep in the money puts on not so volatile stocks that now have more volatility? For example, let's take an example here. Oh, let me clear up my drawing. All right. And I want to go to custom spreads. My apologies. On NVS, something that usually doesn't have a lot of volatility, according to RAM, I have a 120 put on NVS. Okay, and this is a married put, by the way. I'm sorry. This is following the married. So I'm just going to put 100 shares in, and let's say we got it at 108, and he has the expiration is irrelevant. But we're just going to go out to January, holding a 120 put, and in this case, with a price around 116. So if at 108, if I bought the January 120, it's at 4. Wow, that is low volatility, isn't it? That's right at the money almost. Jeez, that's still low volatility in my opinion, but that's okay. No varieties. So the January 120 put about 130 days out. I bought this a couple months ago. The stock at 108, so it would have been about, I'm going to say 1650. Okay, see what that risk is. All right, 3.6%. That's still pretty low. So I gave myself $12 of intrinsic value and another $4.50 of time premium, which is right about where the at the money options are right now with increased volatility. So this is still a very extreme low risk position for NVS. Now, moving on with the question, we have a 120 put, the stock's around 116. When the stock goes down, let's say for example by $8, do we roll down the in the money put from 120 to 110? If the stock goes back up, do we roll the put up to if the stock goes up to 116, do we roll that new 110 put up to the 120? I read that wrong, so I stumbled there, Ram. I'm sorry. My answer to your question is yes. So even though the volatility is increased here, let's take a look at the historical volatility of your 120 strike put. And I know you don't have you might not have the January Ram, my apologies. So again, I'm going to go to research here from this link. I'm going to go to option research. It shows of all the available data that we have for the option. Deltas, gammas, thetas, vegas, implied volatility. It takes a while to load because it's interacting with the historical tools right now to do what? On this research tool for the option, I can compare the change in stock price versus the change in option bid, change in implied volatility versus change in delta. There's a graph there that allows you to select what you want to compare against. And the default, of course, is the option bid versus implied volatility. And this is interesting to me. I might have been way off on my initial assumption because the implied volatility for this option is actually extraordinarily low. The market volatility is higher, Ram, but for this particular security, we'll check that in a second. Oh no, that would have been back around in April. The volatility is high. Was the market moving? Let's see, that's about April 5th, April 6th. for NVS? Was the market in turmoil at that point, or were we coming up to an earnings date here, and after that earnings date, things settled? But that would apply, of course, if we had earnings here, we would have had earnings here at 7.5. And there's a little bit of increased implied volatility here, but not a lot, and now it's settled again. So it's possible that around 4.8, 7.8, somewhere in that time frame, April 8th, July 8th, that's when the earnings were coming up, and now things have settled. But as VIX is getting higher and higher, of course, NVS's volatility seems to be declining. It seems to be losing value. Your put, I assume, depending on how far back you bought it, you're seeing a good time decay crush on this. You're seeing a good extrinsic crush on this, I should say, because implied volatility has been declining. Now, of course, what I'm highlighting here is about 2 years, right? From January 1st, February 1st, 2023 to now. So, it's a little bit longer than what we'd expect. But that's okay. Even if there's increased implied volatility. Now, what we're talking about here is following the radioactive trading techniques, the married put position that we showed you. All right, so this is our preferred approach, close to it. I'm going to buy a stock. I'm going to buy a far out in time put, usually at least 150 days in the money to keep my risk guaranteed controlled to only 4, 5, 6% or so, depending on the security and depending on the volatility, as Ram mentions. Now, even if I bought into this NVS put when the volatility was higher than it is right now. Right now, the current implied volatility is 0.168. This is at the zero range of its total implied volatility range since the option has been released. The implied volatility is actually very low, even though the VIX is very high. And again, I know this might not be your exact put, Ram, and that's okay. But I'm not even so concerned about that, even if the extrinsic value, if I bought the put up here when it had an implied volatility of 0.30, and now it's half that, it's at 0.16, or near half that. Even if my extrinsic value has decayed, that's okay, because what does that also mean? Well, it also means still I have a controlled risk on the position. I can't lose more than that, even in the worst case scenario. If NVS fell completely down to 105 or 104, the volatility would increase, but still I'm going to be near that maximum loss, 3.4, 3.5%. But what I'm saying, Ram, is even if you're in a position and the implied volatility spikes and your stock falls, it goes down to 8 points, the implied volatility increases, for example. Even if your implied volatility, we were in the January series, even if your implied volatility goes up, in that case, guess what's going to happen? All of the implied volatilities are going to go up, and that's okay. What does that mean? So my 120, this stock falls down to 108, 105, let's say 105. Well, the implied volatility of my put option right now might go back up to 0.22 or 0.23. These are going to increase as well, but that's okay because they're increasing in form. There's not a huge disparity here on an option chain on a single stock in the same expiration. If these go up to 0.56, well, that's great for me because now I can sell into higher extrinsic value with a higher increased implied volatility, but I'm not going to be able to buy cheap into implied volatility of 0.16, the 110 as you mentioned. That's not going to happen. This is going to be increased to about that 0.56 range as well. Vice versa. If it was at 0.56 when I bought it, and I bought it after a wrong run down, let's say it went down to $98 and I bought the 105 put and my implied volatility was at 0.56 at that time, but now the stock's come up to 116 and the implied volatilities are all lower, well, I paid into a high implied volatility that now I don't have. But that's okay because my risk would have been set at 5 or 6%. And now, remember, we're at the 105 strike. We bought the stock at, say, 98 at a 0.56 volatility. But now the stock's up at 116. All right, we've gained 18 points on the stock. Even if this implied volatility is down here and it looks like I've lost $7, $8, and $9 on my put, that's okay because if I sell into low implied volatility now on the put that I bought that was higher, these put options up here, back up to the 120 strike and the 125, they're going to be the same lower implied volatility. I'm still going to get the same risk reduction I would expect, even if they had all stayed at 0.56 percentage-wise. My risk might drop from 6% down to 1%. It'd probably actually be bulletproof If I bought the stock at 98, bought a 105 put, the stock went up to 116, and I moved up to, say, the 125, I'd probably beat a bulletproof position with no risk on the trade, guaranteed profit to the downside in that case. So, yes, in general, on a long-term hold, even as the market is fluctuating up and down on a regular basis, yes, I look to use what we call income method number 9 in the blueprint when the stock falls to lower my put strike price. And then when the stock moves back up, I may roll back to the exact original strike price I would, and I should actually see a benefit from doing that. My experience has been that I've seen a benefit for doing that. Meaning what? I started off originally with a high percent risk on the position, let's say 6 or 7%. The stock fell, and I'm near max loss. Okay, so I roll down to that 105, 110 put. My risk percentage-wise goes up. So it might go up to 9% or 10%. But now the stock recovers, and I move back to that 120 strike. Now my risk might actually be down to 5.5% because of just the way that works. I'm keeping the same expiration in this discussion, by the way. Going to radioactivetrading.com. I want to go in the track record real quick. I'm signed in, so I'm going to see the track record of a full user. I'm trying to think of one that I recently used. I want to say that wasn't Academy Sports. It might have been Arista. Let's take a look here. There it is. Okay. So I started this position off with an original risk of 7.9%. This was Arista Networks back in October. And bought Arista at 120.47. Originally had the March 2025 put at 15.40. All right, so the stock went up, and I rolled up from the 125 to the 130, and I sold a 130 call. Naturally, moving this up at this time, this got the risk down to, I used the income method number 1, and I didn't say what the risk was, but it wasn't bulletproof. But hey, we paid $2.60 to gain 5 points, so I reduced the risk by $2.60. It was $10.87, and then we sold a call for $3.85, so we reduced the risk again. Bought to close the call, though, for about the same price and rolled out for another $3.85. Rolled the call again because it was slightly in the money. Now, here's what I wanted to show you. Later on January of 2023, I rolled down the put. The stock, and it went to 119.45. It had dropped before then. Then that's important. So before then, it had dropped lower. It had been down at 115. Why didn't I move the put when it was starting to drop? Because I was waiting. And Ram, you've heard me have these discussions before. I don't overreact when there's a sudden earnings decline on my position. I had one with PSTG, Pure Storage. It declined drastically. Trex declined drastically too. I haven't rolled those positions yet with the income method number 9 because I'm waiting until I see a specific trend. I don't want to overreact and roll down each time the stock falls 5, 6, or 7 points. That's discussed in the blueprint, how to properly use income method number 9. I waited. So when the stock was below, it was probably down to as low as 112, 113. But I waited till it started to move up, and I saw the technical indicators that I wanted to. We decided to take action in income method number 9. Okay. So we moved out the put, actually went from March to September. So I actually paid a debit to this. But then what happened later on? Later on, we adjusted the put again and did a bear call credit spread. So this would have taken the risk up, and then this would have put the risk down. And it ended up being bulletproof to just 3% prior to the earnings coming out at the close of business that day. But the key is don't overreact. You don't want to do it every time the stock falls. And I'm sorry, I wanted to go here. My apologies. Trex is a perfect example of that for me. It's one of the married put positions that I have in the Fusion portfolio. And as you see, this stock had a major pullback. I mean, I was in the stock, I believe, at about 90. No, it wasn't that high. Was it? I can't remember if it was let's take a look. Sorry about that. I want to go to portfolio. And I'm sorry, folks. I want to go to this one. 16.5% up. Trex original was 89.53. Okay, great. But that was from a few months ago. So the stock was at 89.53 when I got in. I had this lull down to 72 or 74. I remember, sorry, Ram, my cost basis here was at $89. So we're right here, right? Or right here. When this decline happened, why am I not doing an adjustment, as you mentioned, with rolling the put down when it's at 80? Because I'm not seeing what I want yet. The MACD is still negative. I'm still in a negative divergence. I'm still riding the lower Bollinger Band. What I'm looking for is this. When I think the stock is bottomed and I start seeing a positive MACD crossover, that's when I roll down from the 95 put down to about the 75 or the 80 put. And then we wrote it up here. Did I roll back up to the 80 put? Absolutely. I'm essentially here at the same risk I was here, holding the same put. I increased the risk percentage-wise here with the 9, got it back with the 4 here. A little bit of lull, some income method number 1s in there. And then, boom, disgusting. I haven't rolled the put yet. Again, why? Because although this started to show me what I want, I wasn't confident exactly that it had purely hit a bottom and was recovering. Now, it seems to be channeling between 60 and 66, obviously, but I'm looking for something more pronounced, similar to the pattern that I saw over here. That's what I wanted to see. With, still being in a bullish buy, or the last signal on the market sentiment tool being in a bullish buy. And of course, in this decline here, when I'm still seeing the sell warnings and we're still dropping, I want to wait till I hit the bottom before I use income method number 9. And no, I don't want to wait till the top to use income method number 4. I want to use it on the way up and then use other income methods to sort of take advantage of this. That's all discussed in the blueprint. Okay. But that's what I'm looking for. This wouldn't have been a bad time to roll down the put, but I don't think it was exactly the best time. Or I could be wrong. I could be proven wrong. But what do I have still, Ram? Time on my side, time to adjust the Trex position if it does turn around after the disastrous future. It beat earnings, I believe. No, PSTG, I'm sorry, Pure Storage beat their earnings estimates and revenue and everything like that, but their outlook wavered. So yeah, they dropped down from what, 64 something like that down to 45. In the last few weeks, they were 62, 63, and they're down now to 44, 46. What am I not doing with that put? I'm not rolling it yet with income method number 9 because I'm looking for this pattern. I want to feel confidence that I've hit a bottom on this and that it starts to come back and recover. That's what I'm looking for to use that next move to roll down the put here. So I'm sorry, let me scroll back up, Ram. So what I'm saying is 66 here when the decline starts. The stock drops down to 62. I'm holding a 70 put, let's say. I don't want to roll from the 70 to 65 here and then roll from the 65 to the 60 here. I want to wait till I see that pattern that I mentioned, the sort of bottoming, getting back to the SMA 20. And then I'm taking that 70 put with the stock down at 56 and I'm getting $16, $17, $18 for it. And I'm moving it down to, say, the 60 or the 65. And it comes back up, and if I had the 60, I might roll to the 65 at this point. And then the earnings happens in this. I'm okay. It's controlled risk position, single-digit risk. Yes, I want to be making money. Yes, I'm at a loss now when I could have closed, maybe here for a profit after some income methods, maybe even here for a small profit before the earnings. But you know what? I'm okay. The put's far out in time, as you mentioned, same as your position. I'm waiting to see this come back again. The rising tide might lift all boats. We see the volatility increasing, volatility across the market, jobs reports, Fed cuts, what's going to happen, Ram, things of that nature. The election's coming up as well. So I have to wait to see some catalysts for this to do. And if it doesn't do what it does, and I still see this pattern increase, hey, maybe I'll use another income method in the blueprint to take more advantage of the downside. That's perfectly fine too. But Ernie and I do not chase every step of the way. We're not lowering the put each time it hits a new strike level. We're waiting to see what we feel is that bottom. And if it's a broad market pullback, we're waiting to see the buy signals on the market sentiment. That's when we want to enter numerated puts perhaps, or roll down, if we've been in a broad market decline, a systemic market decline, I should say, I start seeing the buy signals pop up on the market sentiment tool. That's when I'm rolling down my puts. When I see the bearish sell warnings, that's when I might start doing income method, selling income method number ones. It's letting me know we're maybe near a peak, and maybe I might add an extra put or do another income method in the blueprint that would allow me to take profit to the downside. This was an earnings surprise, so this didn't count as the bearish sell warnings where I might have done that.